All right, everyone, we're into part 3 now, which is the third part of this question. And what we're going to do here is prepare journal entries to record the first interest payment on June 30th, 2018. So this is now 1 year from the date the bond has been issued, and you'll remember that the bond pays interest annually. Okay, so we'll go back to our spreadsheet. This is part 3 now, and we're going to write journal entries for first interest payment. Okay, give ourselves a little bit of room here. So what we know is when interest is paid, one thing's for sure is that our credit is going to be to cash because cash is leaving the business. And the way we'd calculate that is we'd take the face amount, $4 million, times the stated rate, which was 6.5%, and that's it, because that's our annual interest payment. Now from part 2, you'll remember when we got to December 31st year end, it said that what we had done is we set up a interest payable amount for the first half of the year, because that amount has not been paid. So what we know is we need to debit that interest payable because now cash is being paid out. So interest payable, and that's a debit of 130,000, which is the same 130,000 that we had before, and that clears that account out. And then when we're paying this interest amount, we know at a minimum we're going to have interest expense. And because there was a premium when we first issued the bond, we're going to have premium amortization. Now, the way this question works is, given that the interest is paid annually, the premium amortization is not calculated by reducing the remaining amount and then calculating the amortization again. What you would do is, since you calculated for the first half of the year, this premium amortization would stay exactly the same as 3,119, and the interest expense that we calculated up top over here will also stay exactly the same as 126,881. And the reason for that is because this is an annual interest payment. So we put half of it in the first half of the year, and we put the other half in the second half of the year. If now we were to take, for example, a semi-annual interest payment. So let's assume in the question it said interest was paid twice a year, so once in December and the second time in June. This calculation would be a little bit different. And let's take an example of what that would look like. If this was a semi-annual interest payment, we know the way we would be calculating interest expense is we would have taken the remaining value on the bond. So not the original issue price, which is how we calculate it. So when we go up to the first part, this was the original issue price of the bond, 4229374. And after the first amortization, it became 4226255. So now if we were in a semi-annual interest payment scenario, we would take the 4226255 as our starting point. And let's do this as a formula. We'd take that, we'd multiply it by our market rate, which is 6%, and then we'd multiply that again by half year, which is our time. And if we did that, what we'd see is our interest amount is 126,787, which differs from this interest expense, which is a little bit higher. The reason for that is our amortization. So if all things remaining the same, was we were paying cash of 260 and interest payable of 130. And in this case, what would ordinarily happen is, since you're semi-annual, let's just simplify this. Our credit would be cash going out for the second time of $130. Our debit is to interest expense, and our difference goes to premium amortization. And the difference between these two would be this amount and this amount adjusted, and it's 3212. And what we've learned when we looked at the theory for premium amortization is over time, the amount that you amortize increases back into your bond. Right? So we reduce the premium a little more every time we'd have to do it. So this set of circumstances, or this set of entries, is posted when you're paying interest on an annual basis, and you already had an initial setup for interest payable up top in the first part, or it's the part 2 of the question. And this example here is what you would do if you were in a scenario where you were paying semi-annual interest. So the initial $130 was paid in December, and the next $130 of interest is paid at June. Right? You calculate your cash interest going out, your interest expense using the effective interest rate method, and your premium amortization, which would be the difference of the two. All right, so we'll stop there and take up part 4 of the video, which will be part 4 of the question, where we'll look at what to do when you're retiring your bonds early.